Hello everyone, I'm Edwin. I'm so happy to see you here again. We have talked about MPF, we talked about stock market and also Bitcoin. And I guess it's now the time to talk about the property market, which is the major investment for many people. Previously, we said that the property markets have risen because of the quantitative easing, and you can see that the property price has increased for 4 to 5% in the past 4 months. So how will the property price move in the remaining year? There are several indicators used to analyze property market, such as nominal interest rate, real interest rate, unemployment rate, affordability ratio, rental return, and house price to income ratio, and etc. So among all, there is one which is extremely effective. What is that? It is the real interest rate. So what is the real interest rate? We usually heard about the nominal interest rate. So in terms of borrowing money, nominal interest rate is the annual interest rate we have to pay to a lender. In terms of saving money, is the annual deposit interest rate that we can receive. So as bank operation require cost, bank must charge certain percent on their cost and profit. Therefore, the bank will require a certain interest margin between the lending rate and saving rate. So the deposit interest rate is usually lower than the loan interest rate. Now suppose you borrow money at 6%. Does it mean that your real borrowing cost is 6%? Not really. It depends on the inflation rate. The inflation rate is the annual average percentage increase in price. If the inflation rate is 3% and assume that the borrower spent all of the loan on purchasing an apartment, we assume further that the property price is rising at the inflation rate. Then, although he has to give 6% interest to the bank, his apartment appreciates 3% in value. So the real cost is only 3%. And this is exactly how the real interest rate is calculated. The real borrowing cost can be estimated by subtracting the inflation rate from the nominal interest rate. So for saving rate, the real saving rate can also be calculated by subtracting the inflation rate from the nominal saving rate. But what if the borrowing cost and the saving rate are not that high? Suppose the borrowing interest rate is 2% and the saving interest rate is 1%, based on the previous calculation. We can find that the real interest rate is actually negative 1%. So what does it mean that when the real interest rate turns negative? Suppose a pencil is selling at $1 at the beginning and you are going to borrow $100 to buy 100 pencils. 1 year later, if the inflation rate is 3%, then each pencil can be sold at 1.03. So therefore, the sales proceeds would be $103. As the loan interest rate is 2%, you need to repay 102 to the bank. Then the borrowing actually make you to earn $1 instead of charging you a cost. Don't underestimating this 1%. If we are talking about millions of borrowing and compound several years, the benefits could be tremendous. The above calculation explain why people make a fortune from property investment in the past. The more they borrow, the more they earn. So on the other hand, if a conservative investor put his money in a bank, then he will suffer from this negative interest rate environment. So back to our previous example. Let's say Mr. A originally has $100 and can buy 100 pencils, but he chooses to save for a year. After saving for a year, he get back $101, but the price per pencil has rises to 1.03 at that time. It means that after a year, he can only buy 19.8 pencils. He lost 2 pencils of purchasing power. So a negative interest rate means that the purchasing power is decreasing for people who save over time, while borrowers' financial position actually get improved instead. So under the negative interest rate environment, how would people react? People will have a high incentive on consumption or investment, since they predict that the price in next year will be higher than the price today and the interest rate is low, why not they buy it right now? When many people share the same view, the demand of assets could be very high. As a result, assets price will go up. When consumption and investment keep increasing, inflation will rise. But due to the quantitative easing, interest rate will still remain at a low level. Therefore, the real interest rate would be more negative. From the diagram below, we can find that since 2004, Hong Kong's real deposit interest rate is almost non-positive for the whole period. During the same period, the property market has risen from 43.2 points in June 2004 to 170 points in May 2021. The price has risen for 3 times. It seems so crazy, right? But it's not hard to explain. When the saving is too low, much lower than the inflation rate, people know that their money in saving account cannot keep up with inflation. So they cannot even maintain their purchasing power through saving. Then they have to find a way out. The property market provides good returns with no risk, so it's the first choice for many investors. Thus, the huge demand on property drove up the property price in recent years. Now we know that the real interest rate is the most important indicator to predict the real estate market. When interest rate is negative, the probability of a downturn in the property market is highly unlikely. How about the real borrowing cost in the future? In Hong Kong, people like to borrow through the HIBOR plan. Since March 2020, the US government has reduced interest rate to an extremely low level under the linked exchange rate. Hong Kong 1-month interbank interest rate is also priced between 0.1% to 0.5%. As the mortgage rate is usually from H plus 1.5% to H plus 1.8%, the overall mortgage cost is about 2%. Then, is it likely that interest rate will be raised in the future? Not really. So, because the best way for us to predict the future interest rate is to get references from long-term debt, the yield curve. You can see that the 3-month interest rate is 0.01%, the 1-year interest rate is 0.06%, the 2-year interest rate is 0.16%. When considering liquidity premium is priced in for the US long-term bond, we can see that the probability of the increase in interest rate is extremely unlikely to happen in the next 2 years. Under the linked exchange rate, it's also unlikely for Hong Kong's interbank offering rates to go above 0.5%. Therefore, I expect that the interest rate for mortgage for the next 2 years will still be around 1.5% to 2%. Then, what about inflation rate? Inflation rate last year was negative due to the pandemic. It means that Hong Kong has experienced deflation, a drop in the general price level in last year. But in the past 10 years, we can see that the average inflation rate is from 2.5% to 3%. Due to the lower base in last year, when the economy recovers this year, we can expect that the inflation rate will go back to the normal level. We take a look on the commodities price. It's quite shocking that the price increased a lot last year. The increases are from 30% to 100%. When raw material price keep increasing, the producer will actually transfer the cost to the consumers. Therefore, the increase in the price of final product is unavoidable. So an aggregate guess of the inflation rate in the next 2 to 3 years is probably 2.5% to 3%. If we expect the borrowing rate is 1.5% to 2% and the inflation rate is 2.5% to 3%, then the real borrowing cost would be negative 1%, which means an environment of negative interest rates. So I'm quite sure that assets price will inevitably rise in the coming years. Then the next question is, why do I recommend to invest in the property market the most? Let's make some comparison. The saving interest rate is extremely low. Of course, saving in the bank is not an option. Then, in the current situation, bond yields are unattractive as well. If you buy long, high-yield bond, then the risk is actually much higher than the property market. Furthermore, bond itself is subject to interest rate risk. When interest rate begins to rise, bond price could fall heavily. Therefore, I also do not recommend bonds. How about gold? under inflation, the gold price, of course, would be increased, but compared to assets that can generate income, such as real estate, generating rental income, gold is definitely not as attractive as real estate. Also, the volatility of gold is higher than the property market, so I do not recommend it as well. What about stock? First, the stock picking requires skills and more importantly require luck. Even the stock market is rising in general, some stock would drop as well, such as Tesla and a lot of technology companies. They performed quite well last year but dropped a lot this year. Therefore, investing in individual stock do not only need to the market risk but also some stock picking risk or firm specific risk. Second, stock market is much more volatile than the property market. Third, due to the low risk nature of property market, mortgage loans can significantly increase investment return without imposing excess risks to investors. Therefore, in the environment of negative interest rates, property market is definitely the best option for investors. Now it's time to make a focus on the property market. With negative interest rate in the past 7 years, the property market has risen at an average rate of 8.4% per year. And so in the past 4 months, we find that the property market has risen by 4.5%. And then when we annualizing this 4.5%, 4-month returns, we can get the annualized short-term returns of 14.1%. We can see that the momentum of the property market is stronger than the long-term trend. It can mean that the investors are eager to invest and willing to take risk right now. Here, we expect that the increase in property price for the next 8 months will be between short-term momentum 14.1% and long-term trend 8.4%. By taking simple average, we get the estimate of 11.2%. In the next 8 months, we expect that the property market price will be increased at an annual rate of 11.2%. So which means that the property price in the next 8 months will rise by another 7.5%. So when we adding back the 4.5% increase in the past 4 months, the expected annual increase in property price would be 12% for this year. So in a period of negative interest rates like this year, I expect the annual increase in property price in Hong Kong, or I would say that even in other cities, would be 12%. And I hope that today's video can be used as a reference for you in making your investment decision. So in the next video, I will talk about the best investment that I recommend in 2021. So stay tuned. Okay, thank you everyone for watching today. I'm Edwin. See you next time. Bye.